In this video, we will talk about financial management, budgeting, savings, debts, and investments. So make sure to watch the full video. Personal finance is a term that covers managing your money as well as saving and investing. It encompasses budgeting, banking, insurance, mortgages, investments, and retirement, tax, and estate planning. The term often refers to the entire industry that provides financial services to individuals and households and advises them about financial and investment opportunities. What is personal finance? Personal finance is a term that covers managing your money as well as saving and investing. It encompasses budgeting, banking, insurance, mortgages, investments, and retirement, tax, and estate planning. The term often refers to the entire industry that provides financial services to individuals and households and advises them about financial and investment opportunities. Individual goals and desires, and a plan to fulfill those needs within your financial constraints, also impact how you approach the above items. To make the most of your income and savings, it's essential to become financially savvy. It will help you distinguish between good and bad advice and make intelligent financial decisions. The importance of personal finance. Personal finance is about meeting your personal financial goals. These goals could be anything: having enough for short-term financial needs, planning for retirement, or saving for your child's college education. It depends on your income, spending, saving, investing, and personal protection, insurance, and estate planning. Areas of personal finance. The 5 areas of personal finance are income, saving, spending, investing, and protection. Income. Income is the starting point of personal finance. It is the entire amount of cash inflow that you receive and can allocate to expenses, savings, investments, and protection. Income is all the money you bring in. This includes salaries, wages, dividends, and other sources of cash inflow. Spending. Spending is an outflow of cash and typically where the bulk of income goes. Spending is whatever an individual uses their income to buy. This includes rent, mortgage, groceries, hobbies, eating out, home furnishings, home repairs, travel, and entertainment. Saving. Savings is the income left over after spending. Everyone should aim to have savings to cover large expenses or emergencies. However, this means not using all your income, which can be difficult. Regardless of the difficulty, everyone should strive to have at least a portion of savings to meet any fluctuations in income and spending, somewhere between 3 and 12 months of expenses. Investing. Investing involves purchasing assets, usually stocks and bonds, to earn a return on the money invested. Investing aims to increase an individual's wealth beyond the amount they invested. Investing does come with risks, as not all assets appreciate and can incur a loss. Protection. Protection refers to the methods people take to protect themselves from unexpected events, such as illnesses or accidents, and as a means to preserve wealth. Protection includes life and health insurance and estate and retirement planning. Personal finance services. Several financial planning services fall under one or more of the 5 areas. You're likely to find many businesses that provide these services to clients to help them plan and manage their finances. Personal finance strategies. The sooner you start financial planning, the better, but it's never too late to create financial goals to give yourself and your family financial security and freedom. Here are the best practices and tips for personal finance. Note your income. It's all for nothing if you don't know how much you bring home after taxes and withholding. So before deciding anything, ensure you know exactly how much take-home pay you receive. Devise a budget. A budget is essential to living within your means and saving enough to meet your long-term goals. The 50/30/20 budgeting method offers a great framework. Pay yourself first. It's important to pay yourself first to ensure money is set aside for unexpected expenses, such as medical bills, a significant car repair, day-to-day expenses if you get laid off, and more. The ideal safety net is 3 to 12 months of living expenses. Limit and reduce debt. It sounds simple enough. Don't spend more than you earn to keep debt from getting out of hand. But of course, most people have to borrow from time to time, and sometimes going into debt can be advantageous. For example, if it leads to acquiring an asset, taking out a mortgage to buy a house might be one such case. Still, leasing sometimes can be more economical than buying outright, whether renting a property, leasing a car, or even getting a subscription to computer software. Only borrow what you can repay. Credit cards can be major debt traps, but it's unrealistic not to own any in the contemporary world. Furthermore, they have applications beyond buying things. They are crucial to establishing your credit rating and a great way to track spending, which can be a considerable budgeting aid. Credit needs to be managed correctly, meaning you should pay off your entire balance every month or keep your credit utilization ratio at a minimum. That is, keep your account balances below 30% of your total available credit. Monitor your credit score. Credit cards are the primary vehicle through which your credit score is built and maintained, so watching credit spending goes hand in hand with monitoring your credit score. If you ever want to obtain a lease, mortgage, or any other type of financing, then you'll need a solid credit report. There are a variety of credit scores available. To pay bills, set up direct debiting where possible, so you never miss a payment, and subscribe to reporting agencies that provide regular credit score updates. In addition, you can detect and address mistakes or fraudulent activity by monitoring your credit report. Federal law allows you to obtain free credit reports once a year from the big three major credit bureaus, Equifax, Experian, and TransUnion. 8. Reports can be obtained directly from each agency, or you can sign up at annualcreditreport.com, a federally authorized site sponsored by the Big Three. Some credit card providers, such as Capital One, will provide customers with complimentary, regular credit score updates, but it may not be your FICO score. Plan for your future to protect the assets in your estate and ensure that your wishes are followed when you die. Be sure you make a will and, depending on your needs, possibly set up one or more trusts. You also should look into insurance and find ways to reduce your premiums, if possible. Auto, home, life, disability, and long-term care, LTC. Periodically review your policy to ensure it meets your family's needs through life's major milestones. Other critical documents include a living will and a healthcare power of attorney. While not all of these documents directly affect you, all of them can save your next of kin considerable time and expense when you fall ill or become otherwise incapacitated. Retirement may seem like a lifetime away, but it arrives much sooner than expected. Experts suggest that most people will need about 80% of their current salary in retirement. The younger you start, the more you benefit from what advisors call the magic of compounding interest, how small amounts grow over time. Buy insurance. As you age, it's natural for you to accumulate many of the same things your parents did: a family, home or apartment, belongings, and health issues. Insurance can be expensive if you wait too long to get it. Healthcare, long-term care insurance, life insurance, it all increases in cost the older you get. Insurance can cover most of the hospital bills as you age, leaving your hard-earned savings in your family's hands. Medical expenses are one of the leading reasons for debt. What do you think of our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe to our channel before you go. Thank you for watching.